Cycles. Is a crash looming? What would it take for a housing market crash to happen in 2022? Well, to answer that question, let's look back at history when the last crash happened in 2006, 7, and 8, also 2011, where we see an abundance of homes on the market, and you had big investors, Wall Street investors, hedge fund investors, small investors coming in, buying homes pennies on the dollar due to foreclosures and short sales. Well, you look at this market today, we are in a hot market. We have home appreciation and home values at record highs. Mortgage rates are above 5. How does the average buyer buy a home today? And if they do, is a crash looming right behind it? So let's talk in this video today about, is a crash coming? And if it does, what are the signs we look for? Let's get right into this video. All right, so let's get into this video, folks. I want to talk a little bit about what's happening with the housing market crash, what key components we need to see for this. Also, if you guys don't know, I'm a real estate agent, so check out my LV Crib Tours channel. Subscribe, make any comments. Maybe you guys like some videos, post some comments on those videos. So let's get right into the video. So the velocity of inventory, that's one of the key components, right? How many homes are on the market? Now, if you go back and look at history in 2005, 6, and 7, a lot of us seen that market. You look at the average buyer today is 33 years old. Back then it was about 26 years old. So a lot of people have seen that market, right? And so you look at what's going on with inventory. We all know there's a shortage. There's no secret out there. What you have to look at is, well, if there's a shortage of homes, what needs to happen for us to have a crash, right? We need to actually, change that pendulum and go the other direction, where in a short window, we'll say in 3 months, we need to have homes on the market with a 6-month supply on average, with no demand from any consumer out there. So there needs to be an average of abundance of homes on the market, 6 months or more, right? That's not good for builders either. But if we have that type of market where you have that many homes on the market, nobody wants to buy, the demand is very low. I mean, we're starting to see that where properties are coming on the market a little bit more, but we're not seeing numbers like that where it just skyrockets. So we need to see that in like a 3-month period, based upon this article that I read, that says, hey, you know what? If we get that, that's step one, or that's one component of getting a housing market crash. That's something interesting to look at. All right, so let's dive right into the second component I want to discuss, which is creditworthiness of buyers, right? And let's talk about mortgage applications and also what is happening today and how that would affect mortgages today. So we all know that you look at this hot market and you look at where we are headed. We were supposed to be by 2024, 25, 23% appreciation on homes. We're heading right now for 34, 35. It's a lot hotter market, right? It's just a fire market going on for homes. Now, creditworthiness of buyers, though, you look at their mortgage ratio and being on a fixed payment, and also their overall debt and debt ratio in households. It's a lot better today. Also, there's appreciation going on in homes. You have trillions of dollars overall that we've seen in appreciation or equity in homes that help people reposition. They've refinanced, paid off some debt, things that may have loomed, in 2005 and 6, when the real reason for all that problem was creditworthiness of buyers back then was just not there. You look at subprime loans, right? You also look at adjustable rate mortgages, putting people into homes once they adjust, they can't afford the payment. You looked at no skin in the game, no money down. Well, overall creditworthiness was just not there in 2005 and 6. Also, too, we had a job recession back then. You look at wages today, these wages can sustain, for the most part, these raising mortgage payments. And so overall, you look at creditworthiness of buyers is completely better today. We're not going to ease up on that either. Not everybody deserves to buy a home. Everybody needs to position themselves for the best. But back then it was, hey, bank CEOs want to get, they want to get maybe a bonus. They wanted to get more money. They were doing everything they can to figure out how to get that. In today's world, creditworthiness is really tight. It's not saying it hasn't eased up a bit, but we're not going to go back to that hey, you know what, everybody deserves to buy a home, 60% of our population is going to be homeowners. That might not be true. So we're going to look at that part of it and say, you know what, the second component is creditworthiness of buyers is better today than it ever has been, and it's not going to go back and ease up just to compensate for people that were trying to buy homes compared to 2005 and 6. So I want to talk about also the impact on mortgage rates, mortgage applications. We're going to talk about that here, and also the inventory levels and what we see. So when you look at mortgage rates, yes, they need to go up to cool the market, which they're doing. This is good news, right? We just don't want it long term. We don't want them to keep going up, which leads into recession, which means bonds will yield lower. And so that's not good news. It's good for the interim, but it's not good for long term, right? Balance is the key. So right now we're seeing inventory levels that are in the negative percentile, right? Negative 30% we saw last year. The good news is we're starting to see just a slow tick of inventory coming on the market. Now, you look at where we're at today, negative 14% on inventory. We don't need it to be negative though. We don't want it to be on that side. We want it to be in the positive. We also don't want a surplus of homes. It's got to have a nice balancing act. It's got to be a balanced pendulum, right? Of how much inventory we have versus demand and what rates are doing, and compare all that to having a nice level balanced market. And I would really like to see markets get down, the housing inventory to get back to 2000 pre-COVID-19 levels, 2019. And for me, I'm looking at, okay, overall, are we headed in the right direction? Yes, because the market is starting to cool. We're starting to see more homes come on the market. Rates have rose, right? They've risen a little bit here, and now they're in the 5%. We don't need them to keep going up. And then the other thing is mortgage applications. Okay, mortgage applications are a big key and an indicator in what's going on in the housing market across the country. Mortgage applications are down. That's okay. We need mortgage applications to come down a little bit. And so we've seen that mortgage applications for the past few months, that the data is showing that there's not as much. Refis are dead, rest in peace, right? Rest in peace on rate and term refis. We're not going to see that anytime soon. But all of these things are key components to a housing crash, because if those things keep going the direction they keep going, where we have higher rates, more inventory of homes on the market, low demand, those things are all going to lead to a housing crash. So I'm not going to go with a super bullish thesis on the conclusion that I have on the market. And a lot of people think that investors are going to be there to keep the market up, and iBuying, and people are going to still continue to buy. They will. Do we need a slowing down process or period? Yes. We're going too fast, too quick. Average person out there buying a home, middle income, lower income, wage earning families are not able to afford homes. And so I think this needs to happen. And I also feel that, even having a small recession, having home recession of declines of 15 to 20% on home values is something that may need to take place. Do I want it to see like it happened in 5 and 6? No, I don't want to see a crash altogether, but maybe that. Now, there's a lot of people that would be affected by this if there was a crash. What if you bought your home at the peak of the, you call it the bubble, and everybody always says, well, I want to buy at the dip, the bottom, I want to buy at the bottom. What if the bottom doesn't come? Maybe the bottom is the 15 to 20% decline that you're going to see, and maybe that's your chance to get in. Unfortunately, wages have to keep increasing to accommodate higher mortgage payments and higher prices. Could a crash happen? Yes, it would have to have all of those components in place. Just the data right now, I don't see it happening, but it could happen, and it's not off the table. I think a lot of people would benefit. I can see that it would affect me on properties. And then also, it would also be a positive though too, because if you buy into new properties, they may be at a cheaper cost, because now we have a correction going on, 15, 20%, maybe 25% on homes. And it's natural. We have to go through this process. But if you guys have any questions, please let me know. I love to hear your guys' comments and get your take on if we're going to have a crash or not. This is Dan French. Subscribe, and we'll see you guys at the next one.